if you had figured out the secret sauce, right?
Right.
You can time markets. You
Right.
can do all this. Would you tell anybody about it?
Right. I mean, we talked about taking a sabbatical in Hawaii. If I had figured it out, I'd probably be there.
You'd own an island in Hawaii. Like you.
Yes.
Welcome to The Informed Investor, where we break down the latest financial headlines, bringing in research and insights to help you separate the news from the noise.
It is a great time to be in the market, or maybe it's a bad time to be in the market. How do you know as an investor? Market timing is our topic of the day here on The Informed Investor. Thank you for joining the show. It is brought to you by Dimensional Fund Advisors, who is bringing financial science to investing. I'm Mark Gochner, joined today by Jake DeKinder and Katie Hendricks. Katie, great to have you on the show today.
Thank you.
You are a research director in our research group, obviously, and you've done a ton of work on a variety of topics here at Dimensional, including this topic, market timing.
That's right.
All right, so can't wait to get the insights from you on this one. Jake, I got to read some headlines, and then I know you're going to have a reaction to.
Probably. I normally do.
You normally do. And you got your notes there. You got 2 lines. That's one fewer than normal.
I like to be prepared, Mark.
All right, a couple headlines here. A winning system for timing the stock market. Market timing is the hardest thing in the world, and don't try it. Jake, should I do it or should I not do it?
Doesn't work.
All right, we do a lot of traveling. We do a ton of different conferences, educational events. And Jake always makes a comment. You know, we get a lot of questions at the events we do.
Yeah.
And Jake, what's your comment? You always say.
Most investment questions are market timing questions in disguise. And I really mean that. You know, people are like, well, I'm concerned about geopolitical events, or I'm concerned about inflation, or X, Y, and Z. And and I think they genuinely are. But I think there's an underlying question, which is sort of, help me understand how we can get the good and we can avoid the bad. And I think we're going to get into some of the data that says, look, you can cut it up as many different ways as you want. It's really hard to do.
It's really hard to do, but I think it's pretty natural to try to time the market. I mean, there's just a way to, like you said, I just want the good, avoid the bad. There's got to be some smart people out there that can figure this stuff out. And it probably gets very behavioral too, when you think about the motions of fear and greed, probably.
Yeah. The rewards for getting it right are so huge that, of course, people are out there trying to work on market timing. It's so tempting, which is why so many people look at it, even though the data time and again tell us it really doesn't work.
If you can get it right, you will make an incredible sums of money, which is sort of that greed part of it, right? But go back to the fear part of it, where people just, I think, inherently hate to lose money. There's a lot of research done around that, right? That a dollar lost is much greater pain than the joy of a dollar won.
And there's a lot of news headlines that you read on a regular basis. I mean, look, there's a lot of stuff that's going on around the world. People who stay informed on that, they sort of then extrapolate, well, this event that I'm reading out is clearly going to carry over to what's going to happen in the stock market. And if they're reading a negative event, maybe they think, well, therefore markets are going to drop. And as we've seen time and time again that, you know, you can't predict the future. And sometimes you get surprised that even when you're maybe reading a lot of bad headlines, markets could go the opposite. It's just a hard thing to do. I mean, I go back to COVID, right? I mean, let's think about that, right? You've got this major event, world's shutting down, everybody's locked up in their house. We can't solve that. And the markets did drop for about a month, and then they went on a ridiculous tear for the rest of 2020 and 2021. Like, you just don't know.
Yeah. Even April of last year, when there was that huge dip and then April ended flat, I had a newborn baby, and I missed the whole thing. And then I come back to work right after that happened. I'm like, what's everyone talking about? You know, it seems just as it was. And so these things happen quickly. We can't predict them. And if you try to get in or out based on that, you could be in trouble.
It's tough, you know, but again, I think there's a natural tendency to think that it's obvious that it's got to go one way or another. But that gets into the research side of things, you know, and you go back and look at the evidence, and is there anything out there that can help us think through, is there a way to time the market? Is there a way to identify it's a good time to be in or a good time to get out? So maybe start with some of that and walk us through some of the research out there.
Yeah, so we've spent a lot of time on it. And even though we say it doesn't work and you know, research time and again has not found compelling strategies, it doesn't mean that we've given up. And so we still try to dig in and say, even if we can't necessarily predict when the market will perform well. And what do we mean by that? Typically, we mean stocks compared to bonds. But what about within stocks? Can we predict when certain groups of stocks will perform better than others? So we looked at many, many timing strategies, hundreds of timing strategies. And it seems simple on its face, but you have to choose between many, many parameters that actually complicates the exercise quite dramatically. So If I say, well, I want to get in or out when the market is really high. When markets are high, I expect it's got to come back down. What do you mean by high? Do you mean the highest it's ever been? Do you mean the highest in the past 10 years? And if that's when you get out, when do you get back in? That's a critical question too, because you can't miss the upswing. So we wound up with these strategies that had many, many parameters, hundreds of them. And really the bottom line is that there's no compelling evidence that any of these strategies are better than staying invested. You design your asset allocation as something you can weather these storms, and time and again, that turned out to be the better approach.
Well, and also think about this, right? So let's say that you do sort of play this market timing game. And to your point, it's really hard to do. You get it wrong. You miss one of these runs. So now, I could have been up this amount and now here's where the level is. I mean, what's really the only way you can get back to sort of that previous level or on that previous track is you kind of keep playing the same game.
Right.
And if it's stacked against you time and time again, you keep playing the game. You sort of just keep digging yourself a hole.
Yeah. And we've looked with machine learning. This comes up too, is can AI improve this for us? Maybe it's a limitation in what we've been doing so far that AI or machine learning can improve. And we're starting to conduct some of those exercises. And what we found so far is that more complexity does not translate to better investment outcomes. And I think that's something people can take comfort in, honestly. It's that the market works really well, and just having more complicated tools doesn't necessarily mean that your investment returns are better.
Mm-hmm.
And using large amounts of data and processing them efficiently, that can help us digest market prices, understand what's going on, and that can be really powerful to having a better investment experience. But what it cannot do is tell us it's time to sell today. It's time to buy tomorrow. The evidence isn't there for that.
Well, and you've talked about this, like stock prices is one of the most tracked, studied, evaluated, researched set of data probably in the world.
I mean, talk to any academic that's out there. I can comment on this. My wife's an academic over at University of Texas, and you can validate what I'm going to say here. It is this data set that has been out there forever. Everybody has literally sliced and diced it every single way possible. But again, ask yourself that question of, if somebody had I'll ask you, if you had figured out the secret sauce, right?
Right.
You can time markets, you can do all this. Would you tell anybody about it?
Right. I mean, we talked about taking a sabbatical in Hawaii. If I had figured it out, I'd probably be there.
You'd own an island in Hawaii.
Yes. Yeah. And I think there's so much information that goes into setting those prices. If you have some information, if you have some evidence or research that you believe this stock price is going to do this or that, you trade on that.
Completely.
And then that information is therefore traded on in the market price. So I think there's a little bit of hubris in this belief that I know better than the hundreds of billions of dollars trading in these markets every day. And it doesn't mean that that's not important activity, but it just means that for me to think that I know better than that collective wisdom is so unlikely. And the odds are pretty much stacked against it.
Hey, you had a point I want to highlight that was really important. We talked a lot about market timing. It's just this idea of how can I determine the best way to get into stocks or cash in and out? And you raised a good point there of, okay, then you expand that to say, well, among different asset classes in my investment opportunity set, let's say in stocks. Or then I start thinking about, okay, across 40 plus countries.
Mm-hmm.
That gets really difficult when you can't even decide to be in stocks or cash on that part of it. I want to ask you about a couple, I'll say the major timing strategies we hear about or read about in the press. One of them is the 40-day moving average or the 200-day moving average. What are your thoughts around something like that?
I think if we look at, once we say what is high, what's the right moving average? Why is 200 days appropriate? Why is 40 days appropriate? There's just so many choices that you have to make that it sounds simple and intuitive on the surface, but then when you start unpacking it, you want to actually create an equation that you're going to type in and use. There's so many choices to make. And so then now when you have maybe hundreds and hundreds of choices, by chance alone, one of them is going to work out, right? I mean, if I throw enough spaghetti at the wall, something will stick. So then is someone just going to show you the spaghetti that's stuck? And those are the questions we have to start asking. If someone says this metric really works, well, what are the other ones that you tested? Is this the only one you tested? And then you start to get into these issues of statistical reliability, things just, they happen by chance.
Yeah. And I think about like the 40 or 200-day moving average. What was always odd to me of how that got so much attention is you're telling me, so whatever happened in the last 200 days is going to dictate what happens in the future, which is totally uncertain and unknown. Like, it just made no sense to me whatsoever. And then we get the question all the time and I liked how you phrase that about, well, what does high mean?
Yeah.
How many market highs have we had, Jake?
I think a lot.
Yeah.
How many more are we going to have?
Hopefully we're going to have a lot more. On expectation, we're going to have a lot more.
Otherwise, there is no return on your investment. That's
Completely.
all a market high is.
And
Completely.
if we look actually back at the S&P 500, what happens after it hits a new market high? We can go back almost 100 years with this data. And usually when the market hits a new high, that's when people get a little bit skittish. We found that over the 1, 3, or 5 years following this new market high, the market has continued to go up between 10, 13% over those periods. So there is volatility there, but a new market high in and of itself is not reason enough to get yourself on the sidelines.
Mm-hmm. Well, also too, and I think those numbers are sort of on average. It doesn't mean that every time it hits a new high, it's going to go. But I think that's an important point, right? When it really comes to investing, it's about looking at the evidence, having a sensible plan, and making decisions that put the odds in your favor. And I think that's kind of what you're showing right there is like, look, we're not telling you every time it's at an all-time high, 1 year out, you're going to look great. But on average, it seems to be pretty good returns. So do you really want to fight that? Or do you maybe want to take a different approach that says, maybe I should stay invested?
Well, I think a mindset around that too that's really important for an investor is always remember when we're talking stocks, at any point in time, stocks are priced for a positive expected return in the future. Now, we always know there's a difference between realized and expected, but just imagine that as an investor, you say, well, the market thinks this stock's going to go down 10% over the next year. Okay, it's already down, or it'd go down right then. Right? Otherwise, nobody would ever buy a stock if there was a negative return there. So I think just for the audience, always remember that, and that's why these numbers, I think, can make sense when you're at a market high of why there's a positive return in the future is it's priced for a positive return into the future.
Right. I spend a lot of my time looking at asset allocation research as well. And I think a lot of it comes down to your asset allocation. Stocks are volatile. We know that if you compare stocks to bonds, there's higher chance of outperformance, but there are periods of time when you're losing. And that's why we take that risk. But for investors who may be not comfortable with that level of risk, that's why you may introduce some lower volatility assets into your overall asset allocation. And then that can help you smooth out this ride and you find a place that on expectation, you're comfortable. If I have only 60% of my portfolio in stocks, I know there's going to be some bumps to this ride, but I have my bonds to help smooth that out. And as a long run investor, that's my highest probability of a good investment outcome, staying in my seat.
I want to come back to that in a little bit, but I want to ask you one more, I guess, market timing signal that we had asked about a lot, which is this idea of the CAPE ratio. So give us your thoughts around the CAPE ratio, and then we can transition into, okay, well then where you're going, what do I do if none of this stuff works consistently?
So the CAPE ratio is that cyclically adjusted price to earnings ratio, also called the Cape-Shiller ratio. It looks at the price of a stock or an index scaled by the average earnings, and that's over the past 10 years. So typically people look at this CAPE ratio as an indicator of when that ratio is high, that a market underperformance or crash is looming. And this was quite famous around the dot-com bubble because the CAPE ratio got very high. And then, of course, we had a rough couple of years following that for equities. The thing about the CAPE ratio is it's actually notoriously poor at predicting short-term performance. So yes, if you look back historically at a graph of the CAPE ratio, it was at its peak right before the dot-com burst. But it hit a lot of new highs for years leading up to that when the market continued to outperform. And so to use that as an indicator of when I should get in or out, you're going to potentially miss out on some very positive years. So it's interesting. I don't think it's something that's actionable.
It got a lot of attention, like you said, at the dot-com peak there, when it actually, I think, had a negative outlook for stocks over the next 10 years. And that is what happened. I think the S&P, had a slightly negative return, like minus 0.9% for that lost decade time period, the 10 years there. And recently, it popped up to that point again where it had a negative 10-year outlook. I think that was January of 2021. And we got a lot of questions like, okay, well, what if that happens again? So any guesses on the return of the S&P 500 from January 2021 through May of 2026?
Really good.
Yeah.
How about really, really good?
Yeah.
I'm going to get the right number here. So the return of that time period, January 21 through May 2026, 15.5% annualized. If you pull out of the market
Yeah.
because of something that got it right one time,
Yeah.
that is a massive loss, and I don't know how you recover from that. I mean, it takes years and years to recover from that missed return.
Well, you may never recover. I mean, look, remember that once the returns are gone, you're not getting them back unless somehow you figure out how to do better than the market, which that point I was making earlier of you got to keep playing the same game. And on average, you might be digging yourself a bigger hole.
Mm-hmm.
All right, so no research, no evidence. You can time markets.
Wait, I got a question. Can I ask a question?
Yeah.
Are you sure?
Well, I'm the moderator, but
We're going to switch roles for just a second here. On all this analysis that you've done, and you don't have to get into all the details, but where do transaction costs and taxes and all of that? Because I feel like sometimes people just sort of skim over that. They're like, oh, look at this data, look at this. And you're like, yeah, but the reality of there's frictions in the world of investing.
Yes.
Yeah.
Yes, totally. I think that taxes are a huge one, that transaction costs sometimes get in, people work them in. The results that we've talked about would be even worse when you think about transaction costs, but taxes are a huge one as well. I mean, that's something that will really start to eat away at your take-home net returns over the long term if you're churning a bit like this. So these are just additional headwinds that mean maybe instead of being at net neutral or zero through these strategies, you're going to be net negative.
Right. See, I asked a question about taxes just for you, man.
You're assuming somebody made money market time.
That's a good point.
That's a good point. Mm-hmm.
All right. No evidence this stuff works reliably. So what does an investor do? Like, what's the mindset they should have? What are the decisions they can make to put the odds in their favor? Jake, I'll start with you.
Stick to your plan. No, I mean, and here's what I mean with that. And we've talked about this before. I think in a lot of aspects of life, the smarter you are, the harder you work, the harder you try, the better you do. It's really tough of investing because sometimes it's almost the exact opposite of you think you're smarter than the market. You try really hard. You get in and out. You play all of these games. You drive up transaction costs, potentially taxable events. You miss out on opportunities. And I think that's a hard mental hurdle sometimes for people to get over that, quite frankly, if done well, investing's boring. You determine what your risk tolerance is. You set your goals. You put together a plan. And then you sort of stick to it year after year. Yeah, you make adjustments when you have life changes. And of course, you rebalance the portfolio. It doesn't mean you don't look at it or work with a financial professional. But I almost feel like people sometimes with investing, they try too hard. And you put yourself at a disadvantage sometimes when you do that.
And I think there's also a lot of financial science that goes into those initial decisions that you make. So I hold a well-diversified portfolio. That's going to increase my probability of a good outcome. I think about perhaps introducing bonds, as we mentioned, if I want to bring down overall portfolio volatility. These are things that we maybe take for granted now as choices for a portfolio, but there's years of financial science that led us to these decisions. And so I think when I think about risk, volatility is something a lot of people talk about. Volatility is one part of it, but I think another aspect of risk that a lot of people internalize is that max drawdown. In times of crisis, how much did I lose? But then how long does it take me to recover? Mm-hmm. And so if we look at those numbers historically, we see global financial crisis, for example, 100% equity portfolio may have been down like 50% and taken 5 years to recover. That sounds like a lot, but 5 years? If this is your long-term investing pool of money, you can probably wait 5 years. So we can look at a lot of that evidence, set ourselves up for success using these tools that are actually quite sophisticated, even though we may take them as simple.
I love this point because to me, this is this concept of journey versus destination. And I think this industry too much has gotten on this focus of destination. There literally were like ads that were like, what's your number? And when you do financial planning software, how much you need to retire? And all of that is important. Don't get me wrong, right? But if you don't have a good experience along the way, if you don't feel good about your money along the way, if you aren't able to sleep at night and honestly focus on other aspects of your life, that's brutal. And that increases the probability that you may not stick with the plan. Yep. So getting that asset allocation right and getting a plan that you're comfortable with, knowing markets are going to go up and down. There are going to be major events in the world. Volatility will come. You just got to deal with that as an investor. But what can you deal with and actually feel good about your money along the way?
Yep.
Yeah.
As part of the plan, it's what are my needs, let's say in the next 10 years.
Mm-hmm.
And due to the volatility of stocks, you probably need a longer time
Yeah.
horizon, more than say 5 years,
Yeah.
maybe even 10 years to
Yeah.
think I should be in stocks because they are so volatile. That's where
Yep.
the bonds come into play. I think the other part you're highlighting there, Jake, which is investing is hard. It's hard to see these huge price swings.
Mm-hmm.
And if you get in an environment where the market drops quite a bit and then you don't know sometimes until you're in it, like I can't take this, I can't sleep at
Mm-hmm.
night. It's okay to sort of restructure that weighting between
Yeah.
your bonds and your stocks, but that's kind of got to be permanent going forward. You can't just change it 3 months later when markets have come back.
That's right.
Right. And you
Yeah.
feel better. So
That's right.
Yeah.
okay to readjust, just stick with that plan because that's your new
Yeah.
plan. And going forward.
How freeing is that? Come up with a great plan, sleep at night, stick with it. I mean, it frees yourself to do exactly what you were saying. Have other things in your life.
You know what I call that, or what we call that? You know what it is, Gawker? What is it? It's the low handicap strategy, right? Do you know why it's the low handicap
No.
strategy? Because you don't spend any time worrying about your money or tweaking your allocation or trying to time markets. You head to the golf course and you work on your golf game, right? You probably got more money at the end. You got a lower handicap.
there you go.
Makes complete sense to me.
Join a nice club.
I mean,
Yeah.
come on.
Yeah.
I have one more to play off on that one. Is imagine you are a market timer and your strategy gives you a success rate of 75%. Is that good, do you think?
In anything else, that sounds good.
That sounds
right?
unbelievable. You go to Vegas, you play roulette,
Yeah.
you win 75% of your hands.
Yeah.
That's a phenomenal outcome. It's as if a buy and hold investor is the best possible market timing solution. And what I mean by that is go back 100 years. We have 100 years of data now.
Mm-hmm.
75% of the time you had a positive return in the market.
Mm-hmm.
So it's almost like just accept
Yeah.
that. We don't
Yeah.
know exactly what that'll be in the long-term run going forward, but that's incredible odds of success over time in terms of increasing your wealth.
We hold stocks because we expect them to have a higher return than bonds. If we didn't expect that to be true, we would very unlikely that we would accept the volatility that comes with them. So that's our expectation going forward. Exactly what that number is going to be, we don't know. But do we expect it to be higher than bonds for stocks? We do.
All right, so to wrap up the conversation, I went to some of our friends out in the AI world, and we're going to test everything we just talked about here today. So I went to Gemini, and I asked the question, what is the best way to time the stock market? First response, it is effectively impossible to consistently time the market with success. Love it.
Okay.
Love
Yeah.
it.
And then it went on to say why. So the first thing it said, time in the market beats timing the market. And it talks about missing the best days. And Jake, that's something we talk a lot about where we go to the 3-month time period. If you miss 3 months of being in the market in the best 3-month time period, that has a significant impact on the dollars available to you at that time period.
It has a
Yeah.
huge impact,
Yeah.
right? We know that obviously your return is going to go down, your dollars are going to go down. And I think one of the points too that people fail to realize is that money that you lose out on, it's not just that money, it's the future compounding
Right.
as well. And if you think about the rule of 72, take stocks have done about 10%, divided into 72, your money doubles about every 7 years. So it wouldn't be that, so for example, you're losing 200 grand, right? It's 200 grand, 400 grand, 800 grand, 1.6 million bucks. Like that stuff adds
Yeah.
up. That
Yeah.
is really
Yeah, it's a
big
big
deal.
The compounding over time that's the real cost.
Yeah.
Yep.
Yeah.
So that's where that one's so important. So it talked about missing the best days. It talked about transaction costs and taxes, which you talked about earlier, and it said, hey, if you're an investor that worried about some of that volatility, dollar cost averaging can be an effective way to get into the market. And then it wrapped it up here. So the summary was number one, prioritize consistency. Again, time in the market. It talked about sticking to your plan. Make sure you have a diversified, low-cost portfolio. And then the third one, and I love this one, the less you look at your investments, the less likely you are to make an emotional decision. Great summary for this conversation.
It's great.
It's boom. I like your
Yeah.
computer friend.
Yeah, it worked out really well this time.
Yeah.
We will not use it when it goes the opposite direction.
Yeah.
How about that one?
Never let the truth get in the way of a good story.
Yeah.
And maybe it puts us out of a job if it keeps doing good stuff like this too. All right, Katie, great to have you on the show.
Thank you.
Thanks for joining us today. Great input as always. Look forward to having you back on
you.
another episode.
Yeah.
And thanks to all of you for joining The Informed Investor. We appreciate your time today. Be sure to check out the show notes. We want to highlight a newsletter written by David Booth, our chairman here at Dimensional. It's called Stay Calm Investing. And be sure to subscribe to the show so you know when the next episode is being released. Thanks, everybody. Have a great day.